So look, I think we all know this is an unusual time for our sector. The XBI index has been, pretty much on a very consistent downward trajectory, certainly since the election, largely because of geopolitical events that, I think we don't need to discuss. And so what we wanted to cover on today's webinar was really to focus on this question of what can biotech startups and other companies looking to raise capital do in a time and kind of market context like this? And so we're going to be able to dig into this topic with some really great experts here. You've got two investors, Michele Park with NEA and Bong Koh at Venrock, who really I think can give a lot of experience and expertise on this topic. And hopefully I'll be able to just jump in here and there to add my own perspective as well. So maybe to get us started, why don't we start off with some brief introductions, and maybe I'll ask Michele and Bong to both introduce themselves and maybe kind of give a little bit more color. Talk about how, kind of what kind of deals you guys do in the space, how you got started. Maybe if you wouldn't mind, given that this is an event sponsored by Elevate, talk a little bit about how being Asian American kind of impacted your kind of career trajectory, career arc. So maybe Michele, we'll start with you and then go to Bong.
Okay, sure. Great to see you both, Chen and Bong. And it's a pleasure to be able to be joined in your company as we try to provide our insights. So I'm at NEA now, and my focus here at NEA is on the private biopharmas for the venture effort. Prior to joining NEA about 3.5 years ago, I was at Clarus Ventures, and that's where I started my venture career. That was back in 2006. And stayed at Clarus up until the time of the Blackstone acquisition. And I moved into investing because I was a Wall Street analyst. So I jumped from the bench. I was doing my PhD in molecular biology. I wrapped that up and I jumped from the bench to Wall Street, and I was a biotech research analyst for about 6 years. Enjoyed the first half. The first half, we focused on microcap and small cap names. And so that was the opportunity to meet with some of the earlier stage companies, some of the founders, as well as the investors as they started thinking about going public. The last part of the time as a research analyst was covering quarterly sales forecasts for large cap names, like, figuring out how Rituxan sales were going to fare every quarter, and, trying to figure out with the flu mist vaccination, manufacturing shortages, how they were going to impact the stock price. And that was just mind-numbingly boring for me. So I knew I wanted to go back to looking at earlier stage opportunities, and that's when I decided to go into venture. At NEA, we look across all stages. So we're multi-stage investors. In addition to doing tech investing, we also do life sciences investing, and I focus on the biopharma effort, and we're modality agnostic. We're agnostic to therapeutic category. And so we invest from seed through growth opportunities. So we have a venture arm, and we also now have a growth effort with the same team looking at all the opportunities.
Great.
And then should I let Bong speak and then go into the Asian
Why don't you
experience?
close up on your Asian American impact and then we
Um,
move on?
yeah, the Asian experience. I mean, I grew up in Northeast Pennsylvania, in the boonies of Northeast Pennsylvania. So I was used to being the extreme minority. And so there wasn't really a difference. It was the same in academia. It was the same on Wall Street. And, then I went into the land of VC with very few Asians, especially female Asians. I recall my early years at Clarus, the Asians I knew who were in the business were you, Chen. Back in the day, it was Tao Fu, who was at the time, I think he was at Sios. Albert Cha, you guys were Albert and you, Chen, were at Vivo. And that's about it. And then I had, I think, maybe one female contemporary on the investing side, just starting off in venture. And the female role models, the unicorns that I looked to were, there were very few. Elise Wong, right? She was a senior analyst who was I think she was at Citi, right, when I joined. She's now partner at Deerfield. Megan Ho, who was a senior analyst at Goldman Sachs, right? Those were the two power heavy, just, oh, and then there was Nancy Chang, who was CEO of Tanix, responsible for Xolair. And that was pretty much it at the time. And so it was kind of lonely, right? But it was also a time where I did eventually over time start to see an increase in the number of Asians that were taking more senior roles at companies. And it was also nice to see more females. And now today, I think, it's exciting to see on the operating side as well, right? Especially with Julie Kim becoming Takeda's CEO. And then we have a handful of others that have been doing quite well. So it was a lonely time, but I think it's getting better. I think there's still more room for growth with respect to better representation in more senior roles on the operating side as well as investing side. But I think that we're doing the right thing here with Elevate too, to really be able to propagate this further.
Awesome. Well, thanks for sharing the story, Bong.
Yeah, so thanks very much for having me, Chen. I'm a long-time listener, first-time caller, so I'm a little nervous. But okay, I'm gonna be serious here. So my investment career, I went to medical school first. I've been investing for the last 21 years or so. Been Venrock for the last 15, 16 years. And started off in venture capital, did a whole bunch of different hedge funds, and Venrock's the longest place I've ever been professionally. In terms of what we invest in at Venrock, we're also kind of run the entire gamut in biotech. We have an early stage venture capital side that does tech, healthcare services, healthcare IT, and biotech, et cetera. So that part will start biotech companies. And then the side I spend most of my time on is called Venrock Healthcare Capital Partners, or VHCP. And we will do typically mid to later stage private companies, usually, before IPO crossover sort of situations. And then once the companies go public, and, I'd say once they go public, it's largely pre-revenue companies, but we manage multiple different funds on the biotech side, and we do have a fund that's targeted towards even larger companies. And so we're therapeutic technology agnostic, and yeah, that's kind of what Venrock invests in. In terms of like just experiences being East Asian, I also grew up in Pennsylvania. I have, bunch of discrimination, people making fun of me for being Asian. That feeling of just being a little bit on the an outsider. Um, it actually was one of the reasons why I went into medicine, was feeling like that's more of a meritocracy-based system, and being Asian really would be less of a handicap and an issue. Um, when I started off in my career, like Michelle said, I looked around and very few people look like me. Um, which just made you wonder, like, what is my career path, what is my career trajectory actually going to be if everyone's senior, none of them actually look like me. um, and so for me, it is actually one of the things that appealed to me about the public side. Was the public side tends to be, I mean, all investing is a meritocracy. How quickly that process works its way through the system is a question, depending on which stage you're investing in. But on the public side, like, within several years if you're good, and if you're bad, and other people know fairly quickly too whether you're good or bad. And so it was actually a driving decision to enter the public side, for me. So
Yeah, interesting. Well, this is crazy. I also grew up in Pennsylvania, so clearly we know where the hotbed of biotech investing is. But I think it is interesting. I mean, I remember in the early 2000s, very few biotech investors had advanced degrees, and that began to change. I think in the early 2000s, where MDs and PhDs became almost like kind of rites of passage to get into the space. And I do think that ultimately ended up driving in part the increase in Asian American representation was because I think we had historically been strong on the technical side. Okay, so let's shift gears and let's start talking about the current environment, because obviously that's very top of mind for folks. And I'm going to maybe start off with actually an audience question that we had gotten. How has your strategy actually changed in this environment, whether it's regard to the profile of companies that you're looking at or the valuation, kind of maybe your thoughts on how that this kind of context has impacted that.
Uh,
Why don't we start off with actually, Michelle, why don't we go with you?
Yeah. So again, my focus is on the private side. And so, the bar's high. It remains high, is what we like to say. But I guess I wouldn't be lying by saying it's a little bit higher, right? So we like to say we're looking for exceptional companies and now perhaps extraordinary companies, and that's tough, right? That's not easy. And so, I was saying earlier, we have the benefit of having a little bit of time, right? Because we've got the capital. the investors are kind of in the driver's seat now, right? There's a lot of companies that we're taking a close look at, but we're deliberating very carefully.
And
I
Michelle,
think
when you say extraordinary, does that imply you want to see clinical data or not necessarily?
no, and not necessarily, although we are looking later stage too, because we aren't as risk averse. We'd like to say, as the prior group that I was with, we were a little more risk averse here. For the right price, we want to find the traditional venture deals, right? The real innovation, the game changers, right? And sometimes you get a feeling with enough pattern recognition, hopefully on the early side. That's tougher though. And so we're still looking at all stages because it's going to vary with respect to what the valuation could be at that stage. But we're also looking at the later stage opportunities. We think that the later stage opportunities, there's more of a chance that we'll be able to discuss or negotiate the valuation, right? Where, in prior years, we probably wouldn't have. It would have just been an easy pass without the negotiation. And so we're looking still across the board, but later stage is always better when you're slightly more de-risked on the, because you've got some data in hand. On the preclinical side, in vivo data sometimes will be encouraging and interesting or compelling. We're looking for novel targets. I know everyone says that, but we just feel like there's so many targets out there that are still untapped. And there's so many targets that are just too redundant with respect to what the efforts are in terms of development. But we like to say it's business as usual, right? We are looking for compelling science for a defined or definable market, right? Strong, backable team. It's the same, right? The same parameters. But we are being very disciplined on valuation, and we have that that we can use with respect to negotiating. And we remain a big fat no on chasing momentum. We just won't do that, right? It doesn't matter what the market looks like. We've just not been fans of, looking to do what others are doing because it's hot.
Okay. So, Bob, I'm going to come to you in a minute and talk about the public side, but maybe one last question, Michelle, before we move on. Novel targets, I guess, you know, um, can you, if you, let's say you put a term sheet on a novel target, let's say you want to do it, can you
Yeah.
even syndicate that deal right now? Meaning, is there a
Yeah.
market of other firms willing to do that novel target deal?
Yeah, yeah. I think it depends on how you can structure the deal, right? And so I think we're also going to be seeing more deals where you have some pretty, heavy tranching, right? Where, you're going to have very defined milestones with respect to the kind of data to trigger the next tranche so that you're minimizing the risk. And so I think that there are some investors who are still willing. I think the challenge there is you want to be able to find enough dollars, right? But if you're tranching it, it should not be as much of an issue. But one of the key, uh, what we tell our portfolio companies and the CEOs is just everything you can do to not run out of money, right? And so what we would say to our companies where their new CEOs coming to us is everything you can do in this financing environment to raise enough so that you're not going to run out of money. And so I think that you're right, it is a little bit more challenging, but there are still some folks who are still looking at the early stuff and only look at the early stuff.
Okay. So, Bob, maybe as you talk, maybe you could talk a little about the maybe the profile on the public side, but maybe since you do both public and private, how do you make the decision whether to do a private deal in the context when the public markets are so down? Like, is there a rationale to do private deals for you when you can do both?
Yeah, I'd say we do public and private. I'd say we're very and private for us is crossovers. We are we are actively looking at both sides. I'd say what's different is we're just finding better value on the public side right now. And so there's more of a gravitation towards that. I'd say the amount of effort being spent right now is equal on both sides. But the deals just are better deals on the public side, which is not surprising. As you know, it can take a while for the private side to catch up in valuation and expectations. We're kind of starting to see that, but not really. And so I think there's hope. Maybe that these private companies have that maybe this won't last as long. Maybe we can be the exception and get a better set of terms, et cetera. And so, but it's just making us do more public investments right now. And on the private side, I'd say the one thing we're just not interested in is people who just have unreasonable valuation expectations. I think all of us are reading the news. I think when you have a public portfolio and you watch it go down, right? Like everyone's public portfolio has gone down over the last like 5 or 6 months. You just tend to view things very differently than if you're just kind of this private company where you're not really living the reality, right? But there's a big shift, I'd say, among public crossover. There's public people, a lot of public people do crossovers. I definitely think there's a big shift in mindset that has occurred. Like people just are not interested. Like flat is the new up, and just people just have to be
Yeah.
very realistic about resetting the expectations. Because I'd say the other thing that is happening with public investors as they look at private companies, well, first of all, some people just can't do them anymore. I don't know if people know this,
Yeah.
but like a lot of these public funds, you have a certain percentage of private you can do. So those valuations tend to get marked at the same mark they were like last year. But if your public portfolio now has contracted substantially, now your privates as a percentage of your overall portfolio is too large. And you literally cannot do any more private investments. And so one, you're having a big contraction happening on that regards. Two, I think funds like ours, actually all three of our funds, we don't have that issue. But at the same time, it's like, look, we're just not interested in paying high prices at this point. Like we are living this reality. And I'd say last, it's something we've talked about before. There are potential structural changes to our industry that are occurring right now. It is making everyone, I think, either totally gun shy, not wanting to do anything, or they just want to feel like they're getting really good deals in a way that I think we didn't really see in prior downturns. Anyway, so I'll stop talking.
I think that's great.
I'll stop rambling.
No, I think that's really helpful. I mean, I think one of the audience questions, I'll pull an audience question from Angela. So let's say let's say you're an operator now and you're trying to raise money in this context. Given some of the things that you just said, Bong, around the psychology of the investor, like what are things that you should just don't do this in your pitch? And then alternatively, maybe Michelle, you could say, well, what should you pitch about? Like, what are the things you want to include? So maybe Bong, I'll give you the don't do this, and maybe Michelle will ask you the but do these things. Maybe we'll start with you, Bong, on the don't, like what are the don'ts on that first pitch?
I think for us, one of the key issues is valuation. And giving a total absence of guidance on valuation for us, it's like you better be super, super interesting as a company for us to tolerate that. Otherwise, it's like, okay, well, let us know when you actually are going to give us guidance on valuation because we have so many things to look at right now because the people who actually have cash to invest is actually that universe has gotten smaller. We just have so many things to look at right now. Like we need some sort of guidance. And conversely, is if the guidance is like we expect a dramatic step up, again, you better be a super, super, super interesting company. Otherwise, like we will lose interest relatively quickly.
Yeah, I agree. I was going to say, oh, it's not as interesting to leave out the don'ts. And so what I was going to say is don't not include a slide on your financing history, right? And we're going to ask ultimately what the valuation was, what the post was, what the pre was. And if you leave it out, then it just makes us suspicious that you're going to want that up for discussion, right? We need to see the numbers and you're going to have to share it anyway. And so, you should include it so we can have that discussion because it's very relevant right now. And to Bong's earlier point, the companies that just aren't really, getting it with respect to, understanding that the valuations might not really be able to sustain themselves. They have investors around the table who are aware, right? So it's either the investors are bad investors who are telling them that they should expect an up round or a flat round, or they're not listening to their investors, which is also kind of a problem. But I think that what they should include, the other don't, because I want to include another don't, is timelines that are too aggressive. I think that we've seen it so many times. For us, it raises questions on not credibility, but just are you aware of how long this actually takes, right? Like you don't want to overpromise to the extent, I know you're trying to raise money, but you don't want to overpromise to the extent that, it raises questions on whether the management team really understands, what the times are. To get to certain value inflection points. And then I think these days what we're telling CEOs is just, you need to maximize your options. So you have to be constantly contingency planning on everything, not just on the financing, but also just on execution, right? And so, the budget with a breakdown of the dollars to those data points, that's very important because that signals to us that you have a good understanding of your capital expenditure requirements, not just for the current raise, but as well as, the near term financing after that for subsequent financings. And then also it shows that you have thought about various scenarios for some contingency planning. You don't have to show that on the slide, but understand the detail and the breakdown behind the numbers.
Yeah, I agree with that. I think having some visibility on what not just this financing will cover, but what the next financing will look like is now becoming more important because I always like to say in our business, there's three types of risk. There's operating risk, the technical risk, does the drug work, and then there's financing risk. And right now, financing risk is a huge issue
Yeah.
because even when the first two are satisfied, you still may lose if the financing risk isn't covered. Let me ask you a tough question. One of the feedback that I've heard is, look, you've got these Chinese companies out there getting to proof of concept for way less than the American companies. We need to get more efficient to compete with the Chinese. So one, of course, is the regulatory paradigm might have to shift. But the second is a tougher, more awkward question, which is, do we all need to get paid less? Like, meaning, do operators is the notion of a CEO who gets paid 800,000 a year in all in cash make sense in a context where, look, we got to get proof of concept for a lot less than we have today? Do you think it's important for management teams to talk about how they operate efficiently? And I'm guessing we're kind of on the front end of the curve of this, or do you feel like that's a structural problem that's even harder to address today? Or do you think that's a conversation that's going to start to happen in the next couple of months? Maybe, Bob, I'll go to you first.
Well, I wanted Michelle to go
Yeah,
first.
I know. I'm glad. I was like, oof, that's a tough
Um,
one. Go for it, Bong.
our side tends not to sit on boards. We try to not sit on boards if we can avoid it. We don't really have these conversations. I do think, as it relates to, I can tell you how we think about China right now is it's this concern that whatever you finance, 4 months later, the Chinese company doing the same exact thing is like 2 years ahead of you. Like that is the concern. And it's, I don't want to say it's paralyzing, but it's concerning, right? And that concern can drive us not to want to invest, particularly in early stage assets. Again, generally our site doesn't do much in the way of early stage assets. That's the venture side, but it is a concern that can make us not interested. I think it's really important for companies to provide the competitive list to us to know that they've thought about it, that look, they're taking this seriously. And yeah, these are the things. Here's what we know about them, and here's why we think we're differentiated and ideally better. Because not having that can just make us less interested. It does just generally draw us more interested in later stage, like they're in the clinic, because I mean, China can obviously move fast with clinical trials as well, but then it just becomes less of an less of a risk and less of a concern.
Okay, so maybe, Michelle, maybe I'll tweak the question a little bit. What if a management team came to you and said, look, we're actually going to operate in a much leaner way. We're actually going to cut our salaries down by a dramatic amount, but we want more equity. Is that a structure that you would feel compelling again, for more as I think about operators' tactics and try to kind of improve their likely ability to raise money in a market like this? You think that's a compelling pitch or not necessarily?
Yeah, I mean, I think it also depends on where the company is, what stage they're at, and where their equity is at that point in time, right? If it's early on and they have a higher amount of equity and they want more, that's tough, right? Because you do have to continue to raise dollars, right? And so I think it does depend. But on the flip side, when you're earlier stage, the comp isn't as high, right? Because you're not bringing in a heavy hitting CMO, right? Who's used to a certain level of equity and pay. So I think it's kind of going to be a delicate balance. I think it depends. I think there's also some, a benefit to actually layering in, milestones to be able to get that step up, right? In comp, right? So just based on achievements, right? Whether it's a financing or whether it's getting into the clinic or whether it's, getting the full tox package. I think that could be something where you're just incentivizing them and rewarding them that way.
Hmm.
I think going back to just some of Bong's comments on looking at the landscape and what's coming out of China, yeah, they are quick, they're fast. I do feel that right now we have a window because we feel that maybe a lot of the best assets have been harvested, and so now they're planting the seedlings. And yes, the time to harvest is a lot quicker because it's early discovery in China, but there's certain areas where they're not quite as fast yet. Like oncology, they're quick, right? Immunology, I think they're starting to get there, but there's some areas like neuro, maybe rare diseases, obviously rare diseases, right? Which is also a favorable area with respect to the regulatory environment, and hopefully it will stay that way. Um, you know, Maybe cardio, right? So there's some areas where you can still kind of plan to have less of that threat in terms of what might be competitive with your existing portfolio company pipeline or new pipelines that you're vetting as they come
Yeah.
in. I know
So
I
because
steered
you
away a little bit from the whole comp question,
gotcha,
Jen.
gotcha. No,
But
okay,
that was
helpful.
but I did try to address it, the
Yeah.
direct question.
You know, good, good.
No, go for it, Bob.
What I was going to say is just leaner everything is, I think, really important
Yes,
now. Those go-go days are gone. Companies
yes,
raise way too much money, and quite frankly, like it's it's not specific to biotech companies, but if you give someone a lot of money, they're going to spend it. Like
yeah,
I
yeah,
know people in my personal life who have that problem, but like it's just that's just the human tendency, and that's gone. And what's surprising to me is the number of companies that don't seem to get that. Like it's really like what is absolutely necessary for you to do right now. Like it is shocking to me the number of companies that have not gone through this exercise.
yeah,
I think the other thing, just to tie to next value creating milestone, is you really should vet and understand whether that is truly a value creating milestone. Like you should ask public market people, like, is this actually value creating? Because we meet a bunch of companies, it's like, oh, we have cash to get to this key milestone. And you're like, that's not an interesting milestone at all. Like nobody's going to value that. Anyway, so that's one thing that companies can do is like really do your homework on what a value creating milestone is, because it may not be what you think it is.
yeah,
Yeah, makes sense.
yeah.
Maybe as you talked a little about the China risk, Bong, are there certain therapeutic areas that become less interesting modalities? So, for example, like do ADCs or TCEs become less incrementally interesting? Um, is that or is it impacting your way? Because I mean, it sounds like Michelle's saying that there's certain areas where we're clearly out competing them, so maybe that becomes relatively more interesting. Are you seeing that there's a shift now in therapeutic areas that will become more compelling?
Um, Not really. I agree with everything Michelle just said. Oncology's. I also, yeah, I feel like there's so much attention on China now and what are people doing. I actually agree with Michelle. Like it feels picked over at this point in time, the later stage stuff. Again, that's just me. I mean, we've actually spent a lot of time looking through a number of our different companies, and it does feel like the better stuff is picked over. And there's this like huge groundswell of really early stage stuff. I think the one thing that is hard to think through for us is you just look at investment dollars in China. Like they've dried up. Like China biotech venture has taken a really big hit. So it makes sense that everything they invested in like 5, 6 years ago, where there was like a groundswell, like that's kind of like all picked over. And now it's just this really early stage stuff. And so like who's going to finance all of this stuff, right? And I'm not saying China's not a real substantial threat, but you're like, well, if someone doesn't start picking up the tab on these earlier stage assets, like it may not be the big threat that we think it is, at least, in the next 4 to 5 years.
Yeah. I think it's actually quite interesting. There's a potential stroke of the pen risk, which is that the US, of course, just decides, you know what, we're not going to accept Chinese data, for example. Or are there hurdles they could place that
Yeah.
kind of diminishes the attractiveness of this model? One of the interesting things to think about is that pharma, if you think about it from their perspective, it's just cheaper innovation. So they love it. Like it's great for them. But for biotech, it's obviously a lot more of a nuanced plus minus. It could be a little bit less positive for the biotech industry. And so it's notable that there's a difference in kind of incentives between pharma and biotech around that. Okay. We have got a bunch of audience questions that are relate around tactics, and maybe one question again, just to close up the China theme is what do you tell your portfolio companies now around data disclosure? Like, meaning, do you have to be more secretive because of the China risk now? And do you tell your companies to do that, or in the end, you got to raise money, you got to be out there, you should just be telling your story? What have you guys been recommending to your companies on that front? I don't know, Bong, you want to start off, and Michelle, if you have any comments, feel free to add.
Answer is yes. We tell our companies that. Like if you got something super interesting, like how long can you stay? Try to stay private longer, um, because you're going to create your next competitor if you disclose. I mean, that's always kind of true, right? But like it's really true. It feels like with China. So the answer is yes. Secretive longer is better.
Yeah. Yeah, agreed. I think, if you can stay stealth as long as possible, you're better off. And then, if you're raising new dollars, you don't need to put anything on the website. If there are investors who are interested, then, they'll take a closer look under CDA. But
Okay.
yeah, we just have to be very careful. I mean, China's competing internally within China, right? They don't put anything on their websites even.
Okay.
So you really don't know exactly, like if you're doing some intel or diligence on a new opportunity, you can't just go to the websites to see who's working on it.
Okay. So we've got
So
a
yeah.
series of audience questions around, you know, given the market's the way it is, maybe this is not the best time for us to go pitch, is kind of the question. So if that's the case, when should companies start to reach out? Meaning, like, if I'm an operator, should I be coming to you 6 months ahead of your next kind of trial outcome? What's the right way for me to interact with you where it's not like a, kind of intrusive or like a burden to you, but at the same time gives us as an operator a chance to build that relationship with you? Do you guys have any recommendations on when they should kind of begin that interface?
I mean, I think if you're raising capital, there's no too early, right? Just, by lobbing emails or trying to stay in frequent touch, the VCs will decide if this is an area that they do want to track, right? Your hit rate might not be high, but if you have a hit rate, if it's just one or two, and I think that a lot of VCs can provide some helpful feedback along the way as you start to prepare for that financing or that raise. I think earlier feedback is better from the folks that you're going to be going to with respect to, a planned financing. I think that it's probably not that challenging, right? To just keep writing the email and seeing if somebody responds. And then I think also pitching it as not looking, but would really love your advice on two specific topics, right? And just catching 15 to 20 minutes. And then I think just establishing that dialogue. Once you have the dialogue, I think it's harder to just shut down. I
Mhm.
think, starting is the hardest part, but you just have to continue to reach out because you just don't know. There might be a VC that you reach out to who has been looking at that space, right? And already has an interest or has been following that target or that, autosomal, dominant polycystic kidney disease, right? And so
So it
I
sounds
think
like for you, like even if I'm not raising money today, it's still probably worthwhile to just reach out, give you the update, keep you engaged.
yeah, yeah, because there are also teams within all these large firms, right? And so everybody, that other folks are kind of taking more time proactively looking at certain spaces. So you can also send the email or forward it to someone on your team and say, maybe start this dialogue, or if you're interested, it might be worth a conversation and then see if it's worth, near-term follow-up.
Yeah, I agree with everything Michelle just said. Like our early stage venture side, they want to see interesting platforms, interesting science, like truly innovative therapies. Like they're open for business and they're looking hard. So I think it really all depends on the investor, et cetera. I think as it relates to crossover investors, I'd say less interested in that sort of class. Pretty much all the crossovers I know are kind of less interested in that. Um, because we are crossovers, we are also looking at what's happening on the public side. But my sense is that like firms like Michelle's and like our early stage group, like they're open for business. They want to meet with companies, but they just don't. They want companies to have realistic valuation expectations.
Okay. Well, okay. Well, so let's talk about that dynamic. For a lot of operators, that we've got an audience question around, let's say you're a management team and you've got to take the down round. what are the things that they should think about as it relates to like how do they deal with the existing investors to get them comfortable with the evaluation bond that you want as the new crossover person? Is there anything that you any advice that you recommend to them to think about how they would communicate that or various things that they should think about when they structure that deal?
I think it's
Or
really
just take?
understanding. The only advice I could give is like really, really understanding what your board is going through, your board members, their investors, like what is actually happening at their fund. Um, they may or may not want to share, but you can often dig around and ask. Different funds have different pressures. Some funds are quite frankly desperate. They need wins. They don't want to take any more down rounds in their private portfolio, and that's often, if you ask me, that's often a big source of tension. Is when you have an investor like that. So I think really understanding your board dynamics and what is driving, that firm, ideally that individual, I think can help you just at least get insight on how you think about it.
And Michelle, if you're on the other side, if you're on the board of the company that's maybe getting the down round,
Yeah.
how do you take, let's say, a management team's request to get re-upped on equity? And
Yeah.
how, like, what do you think is reasonable for the team to get in that situation and context?
Yeah, I think it's dependent, right, on what additional capital is going to be needed. What additional capital do you need to raise to be able to get to what you think is going to be the exit, right? Or close to the exit that you had envisioned. It's never really exactly what you model. Um, I would say that it also depends on how long the effort was, right, to raise capital. I think what Bong was saying earlier, I think, it is helpful to be able to speak to the investors and know what the dynamics are. But I think just the most important message is that, the company's been going at it and this is the only option, right? And if you don't take the option and you run out of money, then your ownership goes from whatever it was, it doesn't go down a little bit, it goes to zero ultimately. And so I think that the companies and the management teams also understand that. And this is also where we try to think about incorporating, okay, well, you're getting the dollars in, it was difficult, it's a down round. Let's consider a step up, right? Or re-upping incrementally, right? As we start to continue to make progress with the new dollars in.
Yeah. Okay. Okay, I know we're running a little short on time, so I think what we'll do, let me move to maybe, if you don't mind, kind of some closing questions around like how do folks survive as an operator in a time like this? And maybe your top, one or two tips for either how to raise money or how to operate that you think would be critical for folks to survive the next, year and a half. Maybe Bong, I'll go to you and then I'll close with you, Michelle.
I think it's really what do you really need? Like really cutting your cash position. Again, it is striking to me how companies just are not doing this. Or they're doing something and it's like, oh, we'll save $10 million. You're like, okay, I don't really know what that does. It's really taking a hard look at what is really essential for you to really get to those next series of critical milestones. Someone in the chat said, could you give examples? Um, I'd say it all depends on what you're going after. Your indication, your technology, it's like where is the risk really taken out? And I'd say to get that information, hopefully you have some later stage people on your border that and you can ask. And the others is use the banks. Like banks, they want to talk to you, right? They may not raise money on your behalf right now, but they want to talk to you, and they'll freely tell you like, oh, people are not going to care about this or they're going to care about that. So it's hard to give like a blanket statement because it really depends on your technology and the therapeutic area you're in. Um, anyway, that's kind of my advice.
Michelle?
Yeah, I mean, I agree with Bong. You have to be stingy and smart, right? You have to extend your runway as much as possible. At the same time, you have to be paranoid across all aspects. On the financing, you've got to talk to as many people, right? You've got to talk to your existing investors, new investors, corporates, M&A channels, any type of non-dilutive funding that you can get to maximize all the optionality that you could have. Um, I think that, one thing that some CEOs get discouraged by, and you got to just stay in your own lane. You can't get discouraged is when an announcement comes out of a company, that has something maybe similar in the same space, they sell therapy and they do a huge raise, right? but you really don't know the details of that raise. It could have been that in totality the raise was big, but it was a serial, extension of investor capital, right? And so that tends to discourage some operators thinking, see, some of these CEOs think, what did I do wrong, right? Why are they financing and I can't? It's just kind of, your company is different. So you need to kind of stick with your multi-pronged approach on every level, which is financing, operating on execution. Um, I think that one other thing, though, that I think is really important, I recently started thinking about this, is that, an analogy that I have, and some may agree, some may not. And if you don't have kids, then, good for you because you're probably less gray and probably look a little more vibrant. But I feel like an analogy that I've come up with is that, like having these portfolio companies for a VC is kind of like having kids, right? Like in the early days, you put in the hard work to get the company like a kid, and then it's easy and beautiful in the early days. You put the money in, then as they mature, they get really, really expensive really fast, right? Teenagers get expensive. They don't want to share with you anymore, right? They just kind of want to do their own thing. Some of them are good with money. Some of them just want to spend it all. Some of them get a job and save it, but everyone is different, every personality. And so, you need to know what's going on with your teen. And so it's the same with the portfolio company. The more they're willing to share, like I recognize that you don't know the day-to-day struggle that your teenager is facing socially, academically. You're not there with them. You're doing your own thing. And it's the same with portfolio companies. I think a lot of times VCs don't have a grasp of what the daily challenges and struggles are. And so, don't take us by surprise. Just let us know. Like, open the curtain, tell us what the challenges are so that we're not taken by surprise at the board meeting, right? At the report card where you didn't realize that your kid was struggling. And so I do think that going forward, just having that transparency and as much dialogue as possible, because we have our colleagues and we have within our firm, right, to provide the resources, the network, whatever it might be, to continue to help and make those intros to, like Bong said, to the bankers, right, to other VCs, to folks that we know within our network, within the strategics.
Great. Awesome. Well, thanks. Yeah, look, I mean, just to add my 2 cents, I mean, I think being very, like you guys just point out, valuation forward, I think I think operators have to recognize that investors also have scarce capital right now. It goes all the way around. And so the reality is, if it's not a screaming deal, there's a million other screaming deals out there. And so, if you're going to take a down round, don't do a cosmetic one. Do a real one that gets you to the right valuation after this round is completed. So I think being very aggressive on the down round pricing from the get-go will make a big difference in terms of getting traction. Okay, well, thanks to both of you for taking the time out of your busy schedule to share your perspectives. I want to thank everyone for joining us. I do want to mention that Elevate has another virtual event, actually next Friday on June 6th, with someone who's a lot cooler than us, Angie Yu, who's the CEO of Architect Therapeutics. And she's going to talk a little bit about being an Asian female leader. Maybe Michelle, just like you kind of talked about how challenging that was maybe 20 years ago, but obviously it's a remaining challenge today for just how these Asian American women are going to navigate these expectations and norms as they kind of progress in their career. So you can find out about it on the Elevate LinkedIn page, where there's also be a recording of this event if you want to come back to it. But thanks again to all of you for attending, and really thank Bong and Michelle for participating. Thanks
Thank
again.
you.
All right. Thanks, Chen.
Take care, everyone.
Thank you.